Hi everyone. Today I'm going to be talking about mutual funds and ETFs, specifically a particular part of it, in this case expense ratios. Now I'm sure a bunch of you have heard about mutual funds and ETFs and how great of an investment they are. And it's true, but still, even though they're great investments, they're not all created equal. So we have to do our research when it comes to each of them. Now there's many facets to the research, but today I will focus only on one portion of it, which is expense ratios. Before I jump into it, let's just recap for those of us who don't know what a mutual fund or ETF is. Mutual funds and ETFs are basically investments managed by a finance professional. In this case, it's going to be a fund manager. And fund managers and their teams, the main goal is to make you as much money as possible. The idea being is that they bundle both your money and a bunch of other folks' money. So they pool all the money together and they buy multiple assets and investments. In addition, it is an effective way to diversify. Very straightforward, just buy more than one type of asset or more than one asset really, and you've diversified. Not all diversifying is the same, but the fund manager would be responsible for minimizing your risk and maximizing your return within a specific set of guidelines. Those guidelines tend to be determined by the fund managers themselves. Now, as I mentioned, not all mutual funds or ETFs are created equal. One big way that they differ is expense ratios. When it comes down to it, fund managers, they work just like you and I. Their teams work just like you and I, and they need to get paid. Right? How exactly do fund managers get paid? Well, one way is the expense ratio. You can think of expense ratios as yearly fees that are imposed on you so that the fund is able to operate. In other words, there are costs associated with running a mutual fund and an ETF. One of those costs being paying the fund manager and their team. There are other operational expenses as well. Just to name a few, there is the advisory fee, which is really just you paying the fund manager and their team for selecting the right investments for you. Hopefully the right investments for you. There is the administrative fee. This is for record keeping, mailing, customer service, so on. Every mutual fund and ETF generally will have this fee just because they have to do record keeping. They have to keep track of everything that they invest in and sell. And lastly, there is the 12B1, or what some people might call the marketing expense. The goal of that is to basically encourage more people to invest with that specific mutual fund and ETF. And the more people that invest with it, the more money the fund manager and their team have to invest. Just keep in mind that expense ratios are only one type of fee that mutual funds and ETFs charge. Generally speaking, this is going to be an ongoing recurring fee that is charged. I could talk about other types of fees, but let's focus on this one for now for this video. Expense ratios can range anywhere between 0% to sky's the limit. A famous example for 0% is the Fidelity funds. For Fidelity, it's really a loss leader. They bring people in with these mutual funds and they hope that they will invest in other assets and other investments that they will charge for, or they'll provide other services that they may charge for. And then there are expense ratios for mutual funds and ETFs that might be 10% and higher. Those may or may not be good investments depending on your goals as an investor. We can break down the expense ratio math just to make it easy. Think of it like the yearly fee that's charged based on a percentage of assets that you have invested with them. For example, if you had $3,500 in an investment and the expense ratio was 0.1%, that means every year you're paying $3.50. But if your expense ratio was 0.03% for the same amount invested, $3,500, then you'll be paying $1.05 per year. Not a huge difference when you're playing with smaller numbers, but if you had $1 million invested, those numbers will be drastically different. Expense ratios do impact your investments and their return over time because everything you're paying in fees is money that's not reinvested into the mutual fund and further growing your wealth. You can check out this calculator here for you to understand, hey, what exactly am I paying in fees and how exactly does it impact my investments over time? Eventually, your investments won't be $3,500. Eventually, you'll be a millionaire, a multimillionaire. And at that point, the fees will hurt much more. Generally speaking, high expense ratios are bad, right? You don't want to pay a lot of fees. No one wants to pay a lot in fees. One thing to call out is that a higher expense ratio is not correlated with higher returns. You would think that if a fund manager and their team charges you more money, they will be making you more money. Not always true. Sometimes they lose money. Just know that most investors like you and I are probably better off with lower expense ratio mutual funds and ETFs, specifically those based off of an index fund. Index funds tend to have lower expense ratios in general based on the amount of work involved for fund managers. The goal is to have a low expense ratio and high returns. In other words, lower fees and you make more money from your investment. It's pretty straightforward to research an expense ratio. Just do a quick Google search and you'll find a whole bunch of information surrounding it. Pretty straightforward to find. Just look for the fee section. Now, when you stumble upon your research, you might find that there are two types of expense ratios. There is the gross expense ratio, and then there is a net expense ratio. If they're both the same number, then it doesn't matter. If they're both different numbers, then you want to dive a little bit deeper. Gross expense ratios don't take into account fee waivers and reimbursements when it comes to expenses. Now, why would a mutual fund and ETF need fee waivers and reimbursements? Well, by having a fee waiver and having a reimbursement, you lower the cost of investing with the fund, right? So it attracts new investors like you and I. Think of it like a discount to buy an investment. If it's on discount, you're more likely to buy that investment versus another investment that's similar but has a higher expense ratio. A net expense ratio does account for fee waivers and reimbursements and generally will be lower than a gross expense ratio because in this case, you will be paying less. Potentially, you might start off paying the net expense ratio, and if those fee waivers and reimbursements ever expire, you would pay the gross expense ratio. Most of the time, they don't differ that much, but it's a good idea to keep in mind just in case you see something drastically different. You don't want to be surprised by fees a few months later, a few years later, just because you weren't doing an in-depth amount of research on the differences between the gross expense ratio and the net expense ratio. The last topic I want to talk about is the blended expense ratio. The blended expense ratio is an easy way to get a holistic view of expense ratios across all of your investments. Chances are you'll be invested in multiple types of mutual funds, and each of those mutual funds or ETFs will have different expense ratios associated with them. You can follow the Boglehead spreadsheet and just copy it and fill in your own numbers. I've linked it below in the description. It's a great way to determine, hey, what exactly am I paying in fees and for which investment? Once you put in your numbers, the blended expense ratio takes into account how much you have invested for each investment and weighs the expense ratios differently. Obviously, if you have more money invested with a mutual fund, then that expense ratio will weigh more heavily on your portfolio because you're paying more in fees there. This is a good way to figure out, hey, which one of my investments have higher fees associated with them or a higher expense ratio, and try to understand, hey, am I actually making a lot of money from that investment, or am I just losing money or not making enough money? In that case, you may want to consider changing your investments up. Ideally, your blended expense ratio is low. At the end of the day, expense ratios aren't everything. They are ongoing fees for you to be aware of and should be part of your research. The last thing you want is to be surprised by high fees and for those fees to eat into your returns, especially when you're talking about a long investment horizon. In my personal opinion, I think that anything below 0.25% for an expense ratio is great. Anything above that, I would question if it's really worth the value. Obviously, if they're generating a lot of returns, you're making a lot of money off of it, then maybe. Right? Just make sure to discount the expense ratio from how much money you're making. You also don't really need to compare small differences in expense ratios. Now, when we're talking about 0.03% versus 0.04%, it's negligible, right? It's so small. It's going to be hundreds of dollars when you're a multimillionaire. Right? It doesn't make sense to try to figure, hey, how can I get the lowest expense ratio as possible? As long as you're happy with your investments, they're growing, and the fees aren't too high, you're in a great place. The most important thing is that you understand what expense ratios are and how they might impact your investments. All right, thanks for watching. Hope you learned quite a bit, and like and subscribe. I'll see you in the next one.